Go for it.
It was about detecting cancer genes in lung adenocarcinoma. Okay, so let's see. We have a full screen mode slideshow.
You got it.
Yeah. Okay.
Battery.
So this was a tricky talk to put together because I didn't know who was going to be in the audience and if there was any experience with trading or investing. So I just assumed that everyone is a newbie. But if you're not, like, we're a small enough group, we can talk about whatever you guys want to talk about. I'll tell you about my experience, some like common landmines that I think any trader is going to face at some point in their career. And okay, yes, thanks. And then we can explore whatever topics you guys are most interested in. I'm trying to, frame this talk as asset agnostic, because while I traded mainly cryptocurrencies, that's not necessarily everyone's market. And there are still fundamental principles that apply across markets, but specific tactical things like really do depend on the market that you're in. So we can get into that more like as I go forward. So Darwin kind of gave me like a brief introduction. Let's see, I come from a very technical background. Before I started trading about 10 years ago, I was doing a lot of work in machine learning and AI and applying that to computational biology. So I was comfortable with applied, statistics and probability, machine learning techniques, computer science, this kind of stuff. Around 2013, I got really interested in building my own trading algorithm to trade Bitcoin. I'll spare you guys the story as to like why I wanted to step away from academic research at that time, but suffice it to say that I had a pretty technical background, but I didn't know anything about finance. I didn't know anything about trading, and I didn't care about making money up until that point. Really, really didn't care about business. So once I got to the point where I felt like, yeah, I do want to just focus on making money, I looked around. I was really interested in Bitcoin at the time. And many of my peers with a similar technical skill set were making really good money in high frequency trading. And I thought, hey, maybe there's an opportunity to start doing that kind of trading in cryptocurrencies because it's still a new market and there's probably a lot of opportunities that are available because the big players haven't moved into that market just yet. So I got started. I didn't make any money for about 3 years. I was working full time on this by myself. I guess you would describe me as a digital nomad. I was self-funding this, paying for my lifestyle, which was, Airbnb-ing, eating out, having fun with friends, programming during the day through credit cards. I went into about probably $80,000 of credit card debt in pursuance of like finding a trading algorithm that would make money. And I mean, it's kind of crazy. My plan was like, well, if this doesn't work out, I can always go into bankruptcy, go back to doing like academic research. I have a degree, I have a reputation there. Like there's not a ton of downside here. I finally started to make a little bit of money in 2016. And then the market really heated up in 2017. The first real big day of trading, I paid back all my credit card debt with a single day of profit. At the peak, maybe I was making around $100,000 a day, which doesn't last. No trades really last forever. That is a pretty modest income for a professional trading desk by like institutional standards. But as like a one-man shop or one or two-man shop, it's pretty good money. So that's my story. In 2020, so we're not there yet. Oh, this is still all about me.
Sorry about that.
Yeah. How do we go back? Here we go.
Cool. Yeah.
Okay.
Thanks.
Around 2020, I met my current business partner, who was also coming from the high frequency trading world on the traditional finance side, not in crypto. And we thought there was an opportunity to build a product for just regular everyday people who wanted to get started with trading and investing. That product is called Structure. And fundamentally, like we wanted to do that because while trading is an incredible discipline that is so enjoyable on so many different levels, one thing that I think it really does lack is all of your effort as an engineer or as a mathematician or as just, a trader typically doesn't impact the lives of regular people. And we wanted to build a product that people used at this point in our career. And so we decided to transition away from that and use our trading acumen to build a product to help other people get started. This talk is not about structure. So I'm going to tell you more about how I think of trading in an asset agnostic way. Okay, so first to differentiate what we're talking about when we're talking about trading, there are two big classes of traders. One I would call utilitarian traders, and the other class I would call for-profit traders. Some examples of utilitarian traders. When a baker is buying flour, he's buying, it's a trade, right? When a farmer is selling wheat, he's selling, it's a trade, he's selling wheat. Airlines buying oil futures, banks buying interest rate swaps if they're not stupid and are going to blow up their balance sheet. Bitcoin miners selling Bitcoin futures, companies selling shares in IPOs, investors buying assets for the long term, and interestingly, lenders buying puts on the collateral that their clients have given them. All of this is utilitarian trading. The properties of a utilitarian trader is that they make money by operating a business. They don't make money by trading. Trading is what lets their business run smoother. The markets exist because there is a need for utilitarian trading. If there were no utilitarian traders, we wouldn't have markets. There would be no purpose for them. For-profit traders are different. Some examples: scalpers, swing traders, global macro traders, high-frequency traders, algorithmic traders, technical analysis traders, speculators, market makers, hedge funds. What all these guys have in common is they do not care what they are buying or selling. They do not care about what they're trading, only that they are making money from buying low and selling high. That is what their business is. So the subject of today's talk is about for-profit trading, not utilitarian trading, although there's like a lot of interesting things to be said about that as well. And by the way, we're such a small group, like just interrupt me if you guys have a question. Oh, okay. I don't know, they'll figure it out. Okay, making money. It's really, really simple. You got to buy low, wait some time typically, and sell high. It really doesn't get more complicated than that. There's a lot of ways that you go about accomplishing this, but this is what we're talking about. This is the way a for-profit trader makes money. You can also do it in reverse. You can sell high and then later buy low. This would be like a short sell, and then the market goes down, you buy back and close out your position. We're not really going to talk about making money. Making money takes care of itself. What we need to talk about is losing money. Losing money is extremely counterintuitive. So here's an example. If you lose 50% on a trade, how much money do you need to make to get back to even? You need to make 100%. And this relationship holds for everything that you lose. So if you lose 25%, you need to make back 33%. You lose 10%, you need to make back 11%. It's always, in percentage terms, you have to make more than you lost, which sucks. So if you can control your losses, the profits will take care of themselves. You really need to sit and let this sink in to appreciate the way that traders can consistently make money over time. Okay, so I have a proposal here, a betting strategy where if we had a coin, it's a fair coin, every time I flip it, there's a 50% chance that you get a heads and a 50% chance that you get tails. The game pays even money. So if you bet $5 on heads and it's heads, you win $5. If you bet $5 on heads and it's tails, you lose the $5. So suppose we're playing this game and the first bet I make is $100 and I lose, right? So my P&L is, I'm down $100. The next bet that I make is $200 and I lose again. Now I'm down 100 from the first bet and 300 from the second bet. So look at the chart. Hopefully this helps clarify, right? So the first bet, you're down 100. Second bet, you're down 200 more. So total, you've lost 300. If you do it again, you bet 400, you lose again, you're still down 700. What I'm doing is basically doubling my bet size every time I lose. And then, for example, maybe I bet 800 and I win this time, okay? I'll have won $800. I was down 700, so I'm up $100. That's great. This betting strategy kind of ensures that you're always gonna be up some money eventually. You have to win eventually, right? This is a proposal. I want you to think about it through the course of this talk, and we'll revisit it at the end. I am not suggesting that you employ this betting strategy, but you will encounter this in various different forms all across the markets. You also encounter it in casinos in Vegas. Yes, it's called martingaling. Martingaling.
Martingale.
Yeah, the way that you typically see this when you have day traders is people will place an order, the order will get filled, and then the market goes in their face, and then they place 2 more orders, and then it goes in their face, and then they place 4 orders, and they just kind of doubling down and increasing the size because they're like, well, it's got to come back eventually. And I don't know. We'll get to it at the end. Hopefully, it'll become clear why this is not a great strategy. Okay, so let's play another game. This is a coin game. So now we're going to be flipping coins, and it's an unfair coin. There's a 51% chance that it's going to be heads, and there's a 49% chance it's going to be tails. Suppose you have $100. That's your bankroll. And the bet pays even money. You win whatever you bet, or you lose all the money you bet. How much do you bet if you can play any number of times? You can also stop whenever you want, but this isn't a one-time game. And the reason I wrote Fight Club there is last rule of Fight Club is you have to fight. So I do want to hear from everybody in the audience how much you would bet. You can bet $0, you can bet $100, you can bet anything in between, but I do want you to give an answer. So let's start with Darwin.
I would say I haven't quite processed the parameters yet. So basically the coin is a little bit in favor of heads, right?
Yep, it's 51% of the time it's heads, 49% tails.
So I gotta decide, perhaps not in advance. I can see how it goes. I guess there's 2 strategies I could play out. You can decide I'm going to do like 5, bets or something, a priori. Or
So in the first bet, how much money would you bet? And you should bet on heads, right?
yeah,
It's more likely to be heads. So no one bet on tails. But we're betting on heads. And the question is really how much money should you wager on heads?
right. So 0 is not an option, obviously. So
0 is an option, but you're playing a favorable game.
right. So if I just put in 100, let's think that through. There's a shot that slightly in my favor to get to win, right? How much would I win?
You would, if you bet $100 and you flipped heads, you would win $100. So you'd be up $100.
Oh, I'd be up.
Yeah, it pays even money.
God, oh, that's what even money means here. Okay. Yeah, I would do 10.
$10?
Yeah.
$20?
There's something in the first part that would explain this better.
Okay, so we're flipping a coin,
Yeah.
right? And it's an unfair coin.
Yeah.
It comes up on heads 51% of the time. 49% is tails. So you want to bet heads,
Yeah.
right? The question is, how much money do you want to bet on heads, assuming you're going to win even money, and assuming you only have $100?
It's betting a certain amount of money more likely to make you win at the end.
No, like the amount that you bet does not impact the probability that you are going to flip a heads.
But going off the past, what if you bet like $20?
Yeah.
Just on 5 left. Instead of betting 100, you have no chance of winning.
Right, if you bet 100 and you flip tails, you're out of money, right? So that's one downside. So maybe something less than 100,
Probably
$20.
Yeah.
Sasha?
could start with that and then
Okay,
and so how many bets you have
you can play as long as you want. It's like, think of it like a casino game where you can walk away at any point.
Yeah, so I would do 10 and 15 incremental plans, right? 10, 20, 40.
Yeah.
See what happens.
Okay, $10, Zach,
Right.
$1. Okay, 20. Yeah, what about you? All in, $100? $50. Okay. Okay. What about if it was a much more favorable coin, like 60% heads and 40% tails? 30? Okay. Any other? 25? Call it out. No? Leo?
I'm actually beginning.
This Fight Club, you have to.
Okay,
Yeah.
so just one coin toss, I have 100 to spend.
Yeah.
It's 60-40, yeah?
Yeah.
How much am I willing to put on the line? Can I keep
Yeah, you can keep
Sure.
playing. You can keep playing.
playing?
Unless you run out of money.
I would put like 10% on it, maybe 20.
Okay. So
Yes.
10, $20.
Yeah.
I'm sort of revising my thinking there. There's like really no upside to making the bet really large, right?
Well, you win more money faster.
Faster. But can you just pack a lot of trades in like a second or something?
Yeah, I mean, like you can keep playing as much as you want. Yeah.
Yeah, so I mean, I think if you put in a lot of money, that's a huge chance of loss. If you just minimize your loss, I think you'll come out ahead.
Okay, okay, cool. So let's move on. So I want to introduce you to a concept called the Kelly criterion. This is Kelly on the right. He extended an idea that Claude Shannon came up with for information theory. And what the idea is like, okay, in the game that we were just playing, what is the optimal bet size that would maximize the expected growth rate of my capital? And it's very, very surprising. In the game that we were playing, we don't have time to really go into the math and the derivation, but I highly encourage you guys to go check it out. It's fascinating work. In the game that we were just playing, the optimal bet size is actually $2. Betting more than $2 means that your capital will not grow as fast as it could. Betting less than $2 means it will not grow as fast as it could if you were betting $2. In the 60-40 case, the optimal bet size is $20. The reason I wanted to play this game is because human beings systematically overestimate how much they should be betting on something. It is an incredible deficit that we have that you need to get a handle of in any kind of trading strategy that you're employing. This is why I like systematic trading, algorithmic trading, because it takes a lot of the human element out of the equation. This is actually a much easier problem to solve than a trader has. The reason is we're playing a game with perfect information. I'm telling you for a fact, this is a 51% chance that it will be heads, and you can take that as fact. In fact, in the real world, when I'm doing a trade, when I'm employing some methodology, I don't know what my edge is. It's very difficult to calculate until I'm seeing thousands and thousands of repetitions of kind of very similar situations. And so if you extend this problem to have uncertainty about what your edge is, the problem gets even harder. But I think studying this toy theoretical problem is really insightful towards understanding how to manage risk exactly. So
What's interesting, get that into
yeah, I actually don't know the story of that.
Good point.
Ed Thorpe is another really interesting character to read about, who used the Kelly criterion to employ the sort of optimal betting strategy in blackjack. Okay, let's move on. So let's talk about types of risk. Again, succeeding in trading is all about managing your risk effectively. Market risk. This is what most people think of when they think of risk in trading, which is you put some position on, long or short, you own something, and the market doesn't go in the direction you wanted it to. It may continue moving against you. There are lots of different types of market risk. There could be risk that the Fed changes the rates and it impacts the thing that you own in a really counterintuitive way. New entrants in the market can push the market in weird directions. But there are also other very important types of risk. Counterparty risk is something that newbie traders typically don't think of. A counterparty risk is like, if I enter into some kind of transaction with Leo and I'm winning, it doesn't mean that I don't have any risk anymore. He could go bankrupt. He could run away. It doesn't have to be an individual. It could be an institution. It could be your trading broker. It could be the person that owes you money. This is called counterparty risk, and you need to have a good understanding of what kind of risk you're taking on. There is no generalized advice I can give for this because it highly depends on the asset that you're trading. It depends on the venue that you're trading on, the methodology that you're employing. Another very important risk to learn about is what I would call tilting risk. So in poker, when someone has a bunch of bad beats in a row and they start to get really angry and emotional, they call it tilting. And when you get into this emotional state, you behave very differently, and it's usually not to your advantage. So that is another risk of being at least a discretionary trader, where you yourself are deciding what kind of trades to put on and take off. And then the fourth that I would mention is just risk of fraud. So in the cryptocurrency world, nobody ever thought that FTX would blow up, that the CEO would run away with, billions of dollars. All of this, like, fraud is a pretty straightforward thing, but it is not always apparent where fraud is occurring. And one practical way of managing this, of course, is never having too much of your capital exposed to one particular counterparty or one particular, system. But again, the specifics depend on what you're trading. Okay, so here's some other examples. I want people just call out where they think that risk exists in these different scenarios. So scenario one, I buy $100 of some asset X on the spot market, and my target is to sell it at $110 sometime later. Is there any risk in this? Just call it out what kind of risk. Yeah.
So a spot market is something that emerges quickly. Yeah.
Think of just a stock. It's the stock.
okay,
Yeah.
Well, the overall risk was gonna have to be funded, really tank, right?
Yeah. The price of the thing could not go up, it could go down. Yeah, we call it just basic market risk, right? Okay. Second scenario. We're buying this asset X for $100 on exchange A, and simultaneously on exchange B, we're selling it for $110. This is called arbitrage, by the way. Is there any risk in this trade?
Yeah.
What's the risk?
They can't be my brother business.
Counterparty risk, exactly. Exchange A or exchange B could blow up. Any other kinds of risk? Well, yeah, I could stay flat, but I'm saying take for granted that the prices are different here. You can actually miss one side. While you think you can trade at 100 and 110, you go and fire both of those orders off, and only one of them trades.
Yeah.
And then the market starts moving against you. This is very, very common, actually. That would be called adverse selection risk, let's say. So third scenario, you buy a corporate bonds, $100 par value, you pay $90 for it, and it matures in 1 year. Any risk in this trade? Yeah, there's this counterparty risk because the broker or the custodian that's holding it could go bankrupt and steal those funds. There's some other more apparent risks here. Okay, so one of them is it's a bond, so there's interest rate risk. If the Fed raises interest rates, that's kind of like market risk in bonds. The price of that bond is going to fall, and that's not great. There's another risk that is what a bond is, which is a piece of debt. That corporation could go bankrupt and will not pay you out the $100. Let's see. The next example is, so you buy a spot at $100 and you sell future that same asset at 110, expiring in 3 months. If you don't know what futures are, how derivatives work, I guess this example isn't great, but I don't know, you might, or Leo might. Any ideas where the risk is here?
So the future typically has some underlying
Yeah.
asset.
So future is a derivative. It's a contract that says you have to deliver this thing
Right.
at some point in the future. So if you sell a future, then you have to deliver
Right.
that asset in 3 months.
There's all that going with the carbon credits now, right? So
Yeah, I think there's.
yeah. So there's lack of delivery that could be a risk, right?
Well, you're the one selling in this case, so you don't have to worry about that because you're the one that's supposed to deliver. Okay, well, this is a market neutral trade. So in a sense, it's a lower risk trade, but a future has leverage built into it, and the market could move against you. that future could continue going up in price. Spot may not rise at the same rate, and eventually you'll get liquidated on the future if you don't deposit more collateral. And now you're not hedged anymore. So this is I don't know. This is something for certain types of traders. Selling a call option. Any risk in this? Yeah. What would be the risk? Yeah, if the stock goes up, and guess what? Your risk is unlimited. The stock can keep going up and you keep losing money. This is don't do this. Don't sell call options just until for a long time. Any options. Buying a call option is a lot safer, but there still is risk, right? There's no guarantee that that call option is going to expire with any value at all. And so you could just lose your entire investment there. So lots of different types of risk. Whenever you enter into a trade, you need to have a thorough understanding of what kinds of things could happen so that you know how much money you could lose, and you can, like, rule number one, control the amount that you're losing through your trading. Let's see. So risk management, there's a few concepts that if you're serious about learning this discipline, you'll need to learn, and we don't have the space here for me to teach you. But order types, there's lots of different order types: limit orders, market orders, stop loss, take profit, bracket orders, trailing stops. There's an unlimited number of order types. You really should learn how these work before using them and before developing a risk management strategy. They will help you. They're built typically to control risk. Managing your max position size. So we talked through this coin example, right, with the Kelly criterion. This is a theoretical example of, you have $100, you're playing a really favorable game where you will make money over the long run, but you have to be able to, like, in a very disciplined manner, know how to control the position that you're taking on, so you don't have too much loss in any given situation. There's a concept called VAR, or value at risk. This is a very technical concept, but effectively explores the maximum amount of money you could lose under lots of different market scenarios. And this tends to be more of a technique to use when you have very complicated positions with derivatives and a complex portfolio of assets. Counterparty exposure, we've talked about how to manage that as a completely different example, or topic. There are different ways of managing your counterparty exposure. The simplest is to never have too much money with one particular counterparty, because they do blow up eventually over time. And then litigation, litigation is a thing. Like, you need to understand the costs required to enforce a contract. And trading, particularly derivatives, are contracts. And there are many situations, particularly when you're trading over the counter, where it's just, okay, I lost, sue me. Like, this is, I'm not going to deliver, sue me, because it's cheaper to fight that lawsuit than it is to deliver on the loss. This happens a lot.
Yeah.
It's a huge problem in crypto right now, particularly as all the major firms are blowing up. Yeah.
Part of the lawsuit to be recovered the
Yep.
losses.
Yep.
How they cheaper that loss is part of it. Plus the cost of the lawsuit.
Say we do a trade and I just drop 50 grand to you. Guess what? It's going to cost 250 grand to enforce our contract.
Your point is, in order to enforce it, it's important to enforce it.
In a lot of situations, yeah.
But what if you then if that's a apparent fraud, you'd be responsible.
It's not a fraud. Like defaulting on a contract is not against the law, right? If I'm committing a crime,
Right.
Sure.
So would it be a part of the judgment that you are responsible for the?
yeah,
cost, right?
it's very, it can be very expensive to get to a judgment. That's the problem, right? So when you're doing, and we all start out with a very small amount of money, like small potatoes, right? That's how you should start. But I don't know if you guys are in the blockchain, but there is a cost to exercising the law in your favor. Sometimes it's an extremely high cost, and you cannot rely on the law or the contract to make you whole.
Yeah.
Right. This is a very strange kind of thing.
Like what we do this first, right? We get insurance for this, right? We face this one and we
Yeah.
deal with it.
Yeah, insurance exists for this. It's a question of how much it's going to cost you to carry that kind of insurance. Let's see. Arbitrage. Okay. Yeah, go ahead, Leo.
I'm just adding to the last slide, and maybe with you, this is under counterparty exposure, but especially crypto, there's a lot of risk that involves with working with certain brokers that can sell your deal flow or try to front run you.
Yeah.
Or if the liquidity is low, you could be making a lot of money on slippage, or it's
Yeah.
trading under very small floats.
Yeah.
You can lose a lot of money by like just entering an exiting position, so being front run by.
Yeah, absolutely. Yeah, I have a slide on execution costs as like a major problem for small traders. So let's talk about arbitrage a second. This is actually where I first cut my teeth in making money trading. Arbitrage is fantastic. It's not without any risk, but it is a lower risk strategy than taking exposure to market risk. The idea of arbitrage is, you're buying something at a low price, you're selling it at a high price simultaneously. So you kind of like have realized the profit at the same time as you expended the capital. I love trading and I love arbitrage because it is like sort of this real world wisdom. So there's a joke. It says two economists walk into a bar and they see $100 bill on the floor. And the first economist says to the other, hey, look, $100 bill, I'm gonna get it. And the other economist says, no, don't bother. That $100 bill doesn't exist because if it did, someone else would have already got it. And a trader sees that and they just go pick it up. This is what arbitrage is. Theoretically, arbitrage shouldn't exist, but it does. It does in the market. And I think as a beginning trader, you should look for arbitrage opportunities, particularly small ones. And we can talk about why small ones and not large ones, but they do exist. They exist more in novel markets, like really new technologies, or where there isn't a big size in the market because it's not worth it for everyone to go after that. Well, in my case, like back in 2016 or so, I was buying Bitcoin in the United States and selling it in Mexico at a markup. Because markets do like reach parity with one another after there's enough participation and there's enough commoditization of the trade. But when things are created out of thin air and are very new and there hasn't been time, it's sort of like import export even, right? It's like, why can you do this? Because no one's done it yet. And it's like actually a lot of work to set up and take advantage of it. Yeah, so here's some kind of examples of arbitrage. Like we already talked about cross-exchange arbitrage, where you're buying on one and selling on another for a higher price. But there's also stuff that's more market neutral, where you're buying one thing and you're selling a derivative against it that eventually is going to be worth the same no matter what. And you just got to wait for the time when that derivative expires. Again, it's kind of technical. Without knowing exactly how these derivatives work, like you may or may not be able to see how this is a form of arbitrage. But my overall message to you guys is definitely learn about arbitrage and look for arbitrage as opportunities for you to make money in the early days. It's easy to understand, and it can be a fast path to earning some income. Never forget, arbitrage is not riskless. It is just a lower risk type of trading strategy. And we talked about different sources of risk, all of which are applicable in arbitrage. Okay, so let's talk about this idea of Hegelian dialectic. So Hegel was this German philosopher. He had a bunch of theories about history, and he came up with this very simple concept of you start with a thesis, you explore an antithesis, and you get to a synthesis. So in English, basically what that means is you come up with an opinion. Then you do something to express that opinion in the world, and you get feedback from the world. And it usually doesn't match up with what your hypothesis or your thesis was. And then you incorporate that information to revise and make a better thesis going forward. This basically describes scientific method. It describes how we learn. It formalizes this. This is how you get good at trading. So my recommendation is go research the world some amount of time, the market you're interested in, something about the markets. Make an opinion about what is going to happen. Try and make an opinion that you could profit from if you were right. And this is kind of tricky. It doesn't make sense to like, oh, I think, the next president is going to be, this person. If you can't find a way of getting financial exposure to that event, it's really helpful to make opinions about where markets are going because you can actually make a bet there. So then the next step is you open a position that captures as closely as possible what your opinion was, and you eventually close that position. This is the antithesis part. Then you analyze the outcome and incorporate the learnings. This is lather, rinse, repeat. This is what everyone should be doing at the very beginning stages, all the way to the most professional trading firms. You sit and look at the day's trades, you look at what your algorithms did, you look at how your system performed, and you try and revise your model of the way that the world is working, the way that your market is working. You will never have perfect information here. You can only hope to zero in on some kind of advantage that someone hasn't picked up on yet. Lather, rinse, repeat. So how to get started trading. I recommend starting a trading journal. And every day that you do trading, maybe you're going to trade multiple times a day, maybe you're going to trade once a day, maybe you're going to trade once a week, but pick up some finite amount of time and say, I researched this thing for 3 hours. Done. Okay, step one. Then you got to write down, I believed that this thing is going to happen. That's your opinion. Write it down. I put on a position that would let me profit from that thing happening. This is how I put on the position. I bought the stock, or I shorted the stock, or whatever it is. Then fast forward, something happens. Maybe you won money, maybe you lost money. Write down what happened, and then revise what your opinion may have been better to have made more money, or to not have lost as much money as you did. If you do this every day, you will learn the art of trading. This is what the most successful traders have done. George Soros, like all of these guys, they basically keep a trade journal and they are very disciplined with it. Okay, so where to begin trading? How to get started? There's this thing called paper trading, right? You can open up an account, they give you some fake money, you make some bets on the market, and you're playing with fake money. So maybe you lose, maybe you win. Try it out, learn how the order types work, learn what all the little charts and stuff does. Abandon this as fast as possible. You are tricking yourself into thinking that you are learning. You are not really learning when you're paper trading. Start using real money as soon as possible, but very little money. Your whole psychology will change when it's real money as opposed to paper money. So I suggest use the amount of money that you would spend on dinner or drinks. And that could be for the day, that could be, whatever your trading cycle is. It will get you to pay attention more. It'll get you to take things a little bit more seriously. Don't size up this amount of money until you are more confident if you're flipping a coin that's 51% heads or 49% heads, and then you're going to be losing money over the long run. There's a lot of things you could trade. Where should I begin? I suggest picking markets you're interested in. I was really interested in crypto because I thought it was really interesting technology at the time. Some people like listening to Bloomberg and speculating on what corporate actions are going to be taking place. Other people like to follow the news and track commodities. Pick something that you actually enjoy learning about. You will have more of an edge if you're trading that than if you are doing something that you have no relationship with. Maybe you have an unfair advantage in some markets. Maybe you know somebody who's really connected in this industry. Maybe you have prior experience with this kind of a market. That's another place that can where you can find some advantages. We already talked about arbitrage. Always be looking for arbitrage. Remember this concept of a Hegelian dialectic. Constantly be refining your model of how markets are working, and then do your trade journal. Review your trade journal with someone who's dispassionate and objective, who doesn't care. You're in the driver's seat. The way that you see things is not the way someone outside is going to be seeing things. I think accountants and tax advisors are great at this. They don't care. They're like, you're losing money. You're losing money consistently. I know you may win money sometimes, but let's look at the reality here. Don't delude yourself into thinking you can trade profitably win. That's what the numbers don't say. So it's kind of like holding yourself accountable. That's where you should begin. Okay, so let's talk about who you're up against. Actually, how am I doing on time?
I did wonderfully.
Fine. Okay.
Yeah, a lot of time for Q&A. Yeah.
Okay, cool. Who you're up against. I think the most formidable people that you're trading against are high frequency traders. And one of the crazy things about being a trader, being a solo trader, a digital nomad trader, is that you don't get to see who you're trading against. Back in the day, you traded in the pit. You could see who you're trading against. You could talk with them. You know what their business is. Now we trade behind computer screens, and you have no idea who you're trading against. High frequency traders are scary, scary institutions. Many of my peers from MIT are at high frequency trading firms. A lot of people from, Aeroastro, NASA, mathematicians, most people have PhDs. These people starting salary for an undergrad at MIT might be like $300,000 and $350,000. Top of the food chain engineers, they might pay $10 million base salary. It's insane. These are the smartest math and computer science people out there in finance. They also invest huge amounts of resources into their infrastructure. They design specialized circuits to calculate really, really trivial things, but that's all they do because they can do it nanoseconds faster than if you use a general purpose computer. Back in the day, yeah.
I was curious, what's your take? Like, could they be like, how they change, not be allowed? But that's sort of like,
Yeah.
Long-term stock exchange that I don't really agree with that. That's the West Coast stock exchange that is 5 years, I think is one thing.
What is it called?
Long-term stock.
Long term. Okay.
That gonna be like, that's not a part of it. Like, that's gonna be.
Yeah. Yeah, it's a really interesting ethical question. I don't think that there's a right or wrong answer. The way that we design markets influences who are going to be the dominant participants. And there's interesting books on this that people have taken interesting approaches to kind of disadvantage high frequency traders. My take is that I think for some markets, there is a role for high frequency traders, and then in other markets,
It's inherently,
Yeah.
they have a tendency to everything else. It's not a market, it's a good market.
they have some pretty significant advantages. Let's get through like the conversation about who these folks are before we get into kind of that kind of philosophy. Anyway, so 20 years ago, it was the fad to like lay your own fiber optic networks because you could get a straighter line than your competitors going over the internet. And that could earn you like a few milliseconds faster than your competitor. And it doesn't matter that you're only a little bit faster. It's who gets there first, right? Those are the people that make money. Who gets there second, they lose money. Then they transition to microwave networks because microwaves travel faster through air than light does through glass. And we're talking, a few milliseconds, maybe microseconds. But then the problem with microwave towers is that they get messed up by clouds. Microwaves get diffracted. So then they started using shortwave, which not a lot of people know about. Shortwave doesn't have this problem. It actually moves faster. And that was the whole thing. They're investing hundreds of millions of dollars in these networks. Then there's another thing where I got to get a signal from Chicago or New York to London, and the curvature of the earth gets in the way. We're not going to drill straight through the earth. So what do? They bounce radio waves off the stratosphere so that they have a direct line. You don't have to route through this network. It is really, really high-tech stuff. This is what you're up against, okay? They trade on really, really short time scales. Okay, that's high frequency trade. Hedge funds also employ really smart people. They pay them very handsome salaries. They are able to spend many millions of dollars buying proprietary data that you don't have access to, so that they have better information. So hedge funds is not a novel concept, I think, for most people. Finfluencers or finance influencers. I think this is probably the most formidable opponent that you have because it seems like they're on your side.
Like Elon Musk. Taking the statement on something that would you be
No, I wouldn't talk about Elon. Like Elon certainly moves markets because of the power that he has over these companies. I mean the people that are trying to teach you to get rich, right? So like yeah, it's like, oh, let me teach you a system where you can sell options and like earn steady income flow, or let me teach you technical analysis and like, this is always going to steadily make you money. There are people kind of teaching. And the incentives here are really weird. Where these people make money is not always as straightforward as you might imagine. And I'd say ingest like the content, hear what they have to say. but don't forget, they are not your friend. They may be teaching you, but they don't want, like, they're just not, they're not on your side. Usually you are the product. They are selling you to some other business that wants your flow and can make money from it. Robinhood is a really interesting business for this. They don't charge any commissions. They're selling the order flow to Jump Trading and Citadel and other like high frequency traders, because those businesses know that retail traders don't know anything, and trading against them is a profitable enterprise, and they're willing to pay for it. If you aren't paying for a product, typically you are the product, and even when you are paying for the product, sometimes you're still the product. So look, I'm sure there are a lot of people out there that do have good advice, and you can learn a lot from them, but don't trust blindly. This is a really problematic influence in the industry.
I love how you call that Robinhood.
Well, Robinhood has done a lot of great things, right? Like I think they completely moved the needle on great design, changing our expectations for what execution costs there should be. But PFOF, payment for order flow, where you're selling order flow, isn't, I don't think, necessarily problematic. But it is important to understand.
Yeah.
And there are situations where it can lead to a huge conflict of interest, which we saw back in 2020. 2021, I forget. Anyway, so some other problems that you're going to have that you need to take into account are trading costs. So there's this concept of a fair price. Here's an example of an order book where people are bidding at some low price and selling at some higher price, and there's some space in between. We call the spread. Typically, a market maker that's showing these prices would have a concept of the fair price, what the thing is really worth. And it's going to be somewhere in the spread. Say I do this kind of purple dotted line. You never get to pay the fair price. You are always paying like too much for it, or you're selling lower than it. This is how a market maker makes money. So what this amounts to is that unfair coin, you're on the 49% side. You're not on the 51% side, right? So you got to be right by more than the unfair price that you're paying. That's the reality. But you have other costs. It's not just crossing the spread. You're paying trading fees. You're paying commissions. Many places have withdrawal fees to get your money out. And if you have a trade that requires you to move your money a lot, this adds up. You have wire fees, of course. You have infrastructure costs if you're using tools or running software. And then, of course, cost of capital. Like the Fed funds rate is high these days. There are lots of opportunities to make money. And if you're not significantly beating that, even though you may be making money, if you're not making as much money as a lower risk investment would, adjusted for risk, you're basically losing money in expectation. Because no one would offer you a fair price as a market maker because they have no upside in this transaction.
Why does it have to be a market maker? Like, for example, when Bryan sells,
Yeah, you can. If you have like some peer-to-peer transaction, like your friends, and you're like, okay, we'll trade at but this is not a business. A market maker makes his money by, it's sort of like a retail business, right? A market maker is someone who is always available to either buy or sell some asset. And you may want to buy it, you can come to me to buy it. You may want to sell your asset, I'll be a buyer for it.
and so in a normal transaction, let's say I go, let's say, you give an example of Robinhood, right?
Yeah.
If I go there and I want to buy something, what's all the market maker there?
So the prices that Robinhood is showing you is basically the prices that their market makers are showing them for that asset. So say in the case of stocks or options, they're asking Citadel, a market maker, what's the price of Apple stock? And they'll say, oh, I'll buy at $100, I'll sell at $100.01. There's their market, right?
Let's say, I thought it got some stock exchange, like your stock exchange.
In Robinhood's case, they're not connected directly to the stock exchange. They're connected to market makers. But in the United States, there's something called NBBO, which means National Best Bidder Offer, which means they have to show the best price that exists on all regulated exchanges. But there still is a spread there. Like the involvement of the stock exchange is kind of incidental. It doesn't necessarily influence the prices. There may be an opportunity for arbitrage for certain participants, but not you as a customer of Robinhood. Sorry, you had a question? No, okay. Trading costs add up. Usually you can see a lot of opportunities like, oh, there's an arbitrage, or oh, there's this opportunity here. But then you do the calculations, you start running the trade and you're like, ah, fuck, I lost all the money because of trading costs, right? So it's not really an opportunity. Oh, and by the way, your trading costs are higher than the professionals. It's sort of like volume discounts. If I'm doing a ton of volume, they don't charge me as much, which means I have more opportunities available. So this is a challenge for small traders. Okay, as a small trader, you do have advantages. There are lots of trades out there where you can make money, but you can't make a ton of money. There's not what we call large capacity for that trade. And this is important and significant. Remember I was telling you how much money these people get paid? That means that they have a high operating cost. And if I can't make, I don't know, like millions and millions of dollars from a trade, I'm not going to go after it because it's going to cost me like 250 grand to even build the tech I need to go after that trade. Well, if you have that trade and you can do it, maybe that's an opportunity that you have. You can also iterate on things much faster than like a bigger institution. So it might be worth it to you, like taking down 10, 50 grand, worthwhile endeavor to spend a couple of weeks trying to figure out how to do that. It is not worth it for hedge funds and for high frequency traders. You have lower operating costs. That's straightforward. And you also have an ability to find niches that nobody cares about. And this is really what I would encourage you to do. Like there's weird markets out there, like trading sneakers and like trading weird non-fungible things. In my case, 2013, it was Bitcoin. I mean, people were trading it, but not a lot of people had heard about it. It was still pretty early days. I myself am attracted to these kind of weird niche markets, and it is where you can actually find real opportunities. So that would be my advice for you guys to leverage these advantages. Could you give something more recent that you put on as more recent? Well, you know, I stopped running my like prop trading algorithmic business in 2020. So back then I was doing a lot of market neutral trading around perpetual futures and futures on Bitcoin. So this is I definitely stayed in cryptocurrencies. Cryptocurrencies are cool because there's lots of them and they're like all the time being created. And the smaller ones, there's a lot of inefficiencies. There's a lot of places where you can make money. So yeah. Okay. Never forget, nobody cares about you. People will approach you as a newbie trader. You're a huge target for scammers. Here's an example of one I just got yesterday. This is great. Hey, this is Jackie from Crypto Investment Group, blah, blah. I'll teach you to make 10 to 30%. I hope no one is actually falling for this kind of shit. There is more sophisticated attempts at this. Just remember, nobody really cares about you making money in finance. So again, just a lesson, if you can't spot the fish at the poker table, you are the fish. If you aren't paying for the product, you are the product. If I had a system that really made money, why in the hell would I sell it to you? Doesn't make any sense. There is sense in this actually, which is capacity. I may have a system that makes about 10 grand. Like there's not a huge capacity for this trade, but I probably could sell it to 10,000 people on the internet for $100 a pop. And I'm making 100 grand out of this and they're only going to make collectively 10 grand. This is kind of the way that influencers work. Everybody else is going to lose money. So just be very skeptical of these folks. You can learn a lot from them and you should, but just stop at that last threshold. Okay. Things not to do. Don't do it. This whole betting scheme is called martingaling. Don't do it. You'll see it in various forms. It is a guaranteed bankruptcy. Eventually, you'll have a bad enough roll where you just don't have enough money to come back with doubling your bet size. Derivatives, leverage, and shorting. Don't do any of this until you thoroughly understand a lot of stuff. You got to know how balance sheets work. You got to know how margin calls work. You got to know how liquidation engines work. You got to know when you're actually liable for limitless loss. There are situations like derivatives allow you to lose more money than you have and put you in bankruptcy. One of the things I love about the cryptocurrency markets is we didn't develop the infrastructure in that way. We developed it in a way that's like all the money that you have posted on the venue as collateral, that's as much as you can lose. And there are consequences of that. There's the other side of that. But it is pretty nice to know that you can't go bankrupt in many venues. But at the flip side of that is understand how in the cases when you're winning, your upside may be capped. You think you should do $1 million and they only pay you out 100 grand. This can be a disaster, particularly when you're spreading positions and you have another side of the trade that's down 900 grand. You're supposed to be up, 100 grand and now you're down 800 grand because one side didn't pay you out fully. I can get into the details of how that works like later when we're done, but learn basic accounting. Learn, we already talked about liquidations and what a risk waterfall is, like when liquidations occur, who's getting paid out and in what order. Learn how trades can be busted. You can have a trade that takes place, you bought low and then you sold high later and you're like, fuck yeah, I made money. And then something goes wrong and the exchange says, oh no, those trades were wiping them. You didn't make that trade. It happens. It happens on the CME, happens on the New York Stock Exchange, certainly happens on cryptocurrency venues. And then we already talked about this, learn the cost of litigation, because this is ultimately where your exposure is. Okay, so practical problems of trading. If you're gonna go into this discipline, there are things that you might have not considered. You do have a life. You should have a life. You do need to sleep. You do need to eat. You need to take care of yourself. Trading gets in the way of all of this shit. I'm not lying. It's like sort of getting addicted to a video game. It can really destroy your health in many ways. Trading is also very isolating. There's not a lot of benefit to trading in a group typically, depending on the way that you're trading. There can be. I think working with a team is great, particularly if you're building algorithms. But this is a problem, like for the long term. You're going to lose a lot of money. You're going to lose a lot of money on trades that make sense. That 51% coin flip, like you're going to lose money. This is a game that's worth playing, but you lose 49% of the time. And then, as I said before, tilting is the thing. You got to learn self-control. It's more of a thing for other people, but it's a thing for everyone. So keep in mind of this problem. Okay, a little bit of philosophy. So I think trading is a fantastic discipline for everyone to learn. It forces you to confront reality. There are lots of professions out there in the world, and not all of them require you to confront like the physical world and universe, and markets are one of those. Physics is another one. Like you cannot argue with I built the thing and the rocket didn't get into orbit. Like I was right, but the gravity wasn't working. Like there's none of this situation. Consulting and law, like it all kind of like you can manipulate your way into kind of feeling like thinking you're right, because at the end of the day, who's right and who's wrong is kind of what people think in certain disciplines. Trading is not that way. A trader is only as good as the money he makes, and it really forces you to confront your own skill, your own merit, where you have edge, where you don't have edge. So I think everybody should learn how to do this at least at some point. You can't always win. You can have you can't always have enough information. Things go in your face. Things don't always behave as you expect them to. It teaches you how to learn to manage downside risk. This extends into business. This extends into relationships. This extends into all kinds of stuff. You can't control everything. That's self-explanatory. It forces you to constantly listen to the world and adapt, because something that works for a certain period of time stops working, and you have to actually check yourself. You're like, well, this used to work. I'm going to double down and keep doing it. It doesn't. Like markets change, the regimes change, and you have to, it keeps your mind very fresh and young. I hate this thing we see in the media a lot where people have opinions. Where do you think the stock's going? Well, what I bet this is going to happen. No, that's wrong. People have a lot of opinions. Talk is very cheap. At the end of the day, tell me what's in your portfolio and shut your mouth. I don't care about what your opinion is. I want to know what you have exposure to. That is the only true test of someone's real opinion. And learning to trade is a really good way of developing a filter of bullshitters, like just to filter them out. And then something that I like is like you don't make money by selling anything to anyone. That's a personality trait. I like the idea that I can live and die by my own merits, and some luck, because there is luck involved. So this would be like my sell on like why you should bother to learn trading. Most of my talk is about why you shouldn't try this endeavor, why you're probably going to lose a lot of money. But I do fundamentally believe everyone should do it and try. And if you have the right personality and interest, you can make a fuck ton of money. And that's ultimately what this is all about. We're not changing the world. We're not trying to. We're trying to make money. People need money to live, and that's okay. I think it's a pure discipline that is like just agnostic. I can't stand listening to all this like virtue signaling of I think there's like the meme, right? Like in Silicon Valley of and because of this, like Facebook for pets, we're changing the world, like all this. Like it don't be embarrassed about like the need to make money, right? We live in a capitalist economy, and I think trading is a great way of getting straight on that. So some final thoughts, resources. What should I read to learn more about this? These are 3 books that help me a lot and I think are super interesting. The first is Market Wizards. There's a number of books. It's basically interviews with super successful traders employing all kinds of different methods. And you learn a lot by hearing their biographies. Second book is Anti-Fragile. Nassim Taleb has written a lot of books. He's always very interesting. I think Anti-Fragile is more on the philosophical side, but I think it's a really good treatise on the way to think about trading and just investing in life and all this. On a more technical side, an arbitrage guide to financial markets is really good at figuring out how to find arbitrage opportunities and how to construct a technical trade. It really teaches you the nuts and bolts mechanics of the way markets work. There's lots of books to read. Read all the books you can get your hands on, but I recommend starting with these. So good luck to everyone who tries this. If you want to talk shop or talk trading, shoot me an email. Happy to keep the convo going.
Yeah. You crushed it, Bryan.
Thanks.
I actually want to hear about structure. Can you tell me more about that? I know you said you didn't want to talk about it, but I do want to hear about it.
Okay. So Structure is a trading and investment platform for people from the United States. The user experience, the UI is very similar to Robinhood or Coinbase. It is designed to be simple and intuitive. It is not designed to be for professional traders. Like this talk that I gave today, this is like kind of professional leaning, like you're getting serious about it. What the problem that we wanted to solve was that it was really inconvenient to have to manage portfolios across crypto platforms and stock platforms. Like we like to speculate in stocks, we like to speculate in options. I like to speculate in crypto and invest in these. And it's a real pain to have to move money between them. It's a hassle. You miss out on a lot of opportunities. When the market's moving, it moves fast. The opportunity might be around for 12 hours, right? And you can't wait for a 24-hour wire to like fund your account. So what we did at Structure was unify that. We brought both asset classes on the same platform. So you can trade crypto, you can trade stocks, ETFs, etc. And we specifically developed this product for emerging markets. Like in the US, in Western Europe, in East Asia, there's pretty good trading and investment platforms. They're not so great in other countries. They're not so great in Africa, not so great in Central Asia, Latin America. There are options, but nothing that was like really like this very polished tier 1 Silicon Valley kind of app. And this was the niche that we were going at with Structure. So if you're curious about it, it's not available for Americans, not available for Canadians, many people in Western Europe. We have geographic restrictions in this respect, but if this is the kind of product that you're interested in, like check it out. Let me know what you think. We're always trying to iterate and improve the product.
Thanks, man. I think we're just wrapping up. Ashley, you got a question? Do you want to come up here to the microphone?
I was just gonna ask, kind of like what your work-life balance is like. It seems, like how tied are you to your computer on a daily basis, or how often are you checking in throughout the day and like staying updated? Does that get in the way of relaxing in Mexico, or like how does your daily life look doing this full time?
So just to be clear, I am no longer like trading professionally, like running a trading shop anymore. I haven't been doing that for the past couple of years as I started Structure and then building a product. It's related, similar technology, but a different kind of end goal, right? I want to build tools to enable more people to participating in the markets from the ground up. I would say my work-life balance isn't great. Running a startup is not conducive to having a good balance, but trying to get better over time. Yeah, I mean, yeah, I'd give myself maybe a 4 out of 10 on work.
Yeah,
Out of curiosity, why do you use the microphone?
but,
Just out of curiosity, why do you use the microphone?
so people can hear, so we can record it as well.
With this thing?
Yeah.
Okay.
And,
Well, it's less of a question, more of a statement. My third winter in Bryan, when used to go to a lot of talks, this is probably one of the by far the most meaningful and quality wise.
Thank you.
Like quality of those talks you can fly in parallel. It's sad to see just a few people. Because I think that's the block where you can really learn. So you two of you did something novel. Thank you guys.
Thanks, Doctor.
I don't want you to go without some nuts and bolts discussion, like,
Okay.
what tech stack do you use or did you use to do your trading?
I built everything myself in Java primarily. I did a lot of analysis work in R and Python to build the machine learning models. Yeah, so that doesn't help too much, but like in terms of like you think what would be
Libraries.
yeah. I mean, today actually there's better libraries than I was using. So like I was using like libraries like carrots in R and this is old now, right? But you know, pandas and like yeah, the normal, like I'll send you a list. I'll send you a list.
I appreciate that. Yeah.
Sure.
Any other questions?
Sort of like good pop-up stuff.
Good fuck up story, he said. We actually have an event in Playa called Fuck Ups or something. Is that the same thing? He told a great fuck up story at the beginning, actually.
Did I? What did I talk?
You went 80K and
Oh no, I wouldn't consider that a fuck up story. It was just like took me a lot longer to make money. I was going into debt, like because I gotta pay rent, I gotta like, you know, pay for food. Definitely like, so you can blow out on market neutral trades, right? You don't know, like in crypto, there are operators that like you have liquidation points, you have a hedge on the same venue, but they can push the market and blow you out, take your collateral, push you the other way, blow you out, and like now you're just down all the money. It is a good hedge trade, but if you're trading against a party that has an unfair advantage over you, and this is their business model, which there are a lot of business models like this in crypto, like lose money. Litigation's expensive. I would say don't manage other people's money. That is like just don't for a long time. It'll take you like, that's a different kind of business. Like you need different kinds of resources for that. So I'd say grow slowly, grow with your own money, be in control of your own attention, and you know, you'll get there eventually. So.
Because that becomes basically an emotional response.
Yeah,
right?
yeah.
And not different for each person.
Yeah.
How do you recognize first? How do you learn, or how do you discern what's your trigger? Like, how would a person know, like, wait, I'm going down, I'm getting too emotional?
I recommend psychoanalysis. Seriously, like regular self-reflection on the way that you're behaving is incredible. And just trading is so good at forcing you to confront yourself in reality. You know, in my particular trades, like I wanted to build algorithms and software that did the decisions for me. So I didn't have a lot of tilting problems. I mean, I think it's fun to like speculate, high leverage, like manual trading, but I don't consider it like a business. It's sort of like fun, like playing craps. It's fun, right? But if this is the style of trading that you're going to engage in, and there's nothing wrong with that, you should set position limits for yourself. You should set loss limits for yourself. At trading firms, it doesn't matter why you lost the money. You're down 50K, you're done. Go home, come back tomorrow, right? And when you're by yourself, no one's going to tell you to do this. Like if you have a boss, they're like, well, turn her off, right? Like send her home. Yeah, I mean, self-awareness, like that's why I said have an objective third party, like look at your performance. Someone that doesn't care about what it's like being you, right? Another good lesson is you're going to lose money on trades. You don't have to make that money back from the same trade.
Right.
Fuck it. The market changed, the regime changed. It's not working like it used to. Get a reset, go make it on something else. This is extremely difficult to learn that like you can't just keep cramming your head into the wall. Some people are better at like adapting really quick.
Right.
But it is hard.
I wanted to call out something you said. You said tilting wasn't a problem for me because I coded up my algorithms.
Oh, no, that's not,
Okay.
it was not a problem.
Oh, that's what I'm saying, was
Yeah.
not a problem.
Yeah,
because
yeah.
I use code.
Yeah, exactly.
Yeah,
So like,
Coding, learn coding.
Right, right.
Yeah.
yeah,
Ultimately, whenever you code, that already brings in your analysis of the problem.
it brings in your model.
It just puts it at a different time.
Yeah, like, but so tilting is a problem when you're getting some emotional response, usually anger. And that is influencing your objective execution of your strategy. If I program it into software, the software is not going to get mad. It may lose money and I'll turn it off. That's fine. That's what's supposed to happen. But manual traders, discretionary traders, where they're deciding when to buy and sell, and they're like, I know it's going to go up, do a big position, and then boom, it goes down in my face and I'm down 100K. Fuck this, right? Market's going to get up, double down, right? It goes in your face again. You can go bankrupt this way really quick. Many firms have been sunk this way because they don't have good risk control. Like I said in the beginning of the talk, making money takes care of itself. If you learn to control your losses, that's it. That's everything. The market goes up as much as it goes down, right? You're going to be right some of the time. But if you are less wrong, like you'll make more money. So.
Right on, dude. Thank you so much.
Sure.
He is so busy, but he came here to talk to us, and I'm so appreciative of that.
Thanks for coming.
Cool beans, man. Lunch on me.
All right, cool. It's about lunchtime, yeah.
Yeah, let's go get some lunch.
Have an idea.
Yeah.